Hi everyone, my name is Alex and I'm a founder of Nauma, a personal finance platform that helps people in tech make better financial decisions. At Nauma, we took the idea of separating financial goals seriously and designed the flow so that portfolio construction and tax planning happen at the goal level, not just the household level. It's a unique feature, and today I wanted to show you how it works and what benefits it provides you when you make the most important financial decisions. Before we start, we would like to get familiar with the theory. When we work on our financial plan and decide how we're going to accomplish our financial goals, we are finding a sweet spot between investment returns and contributions. We can choose the higher expected returns. In this case, we need to contribute less because we expect that our portfolio will grow more over time. Or we can choose lower expected returns. It's going to be here on the y-axis, but then we will need to increase our contributions and save more. One may ask, why would I want to increase my contributions? Why not someone else, in this case the market, work for me and grow my portfolio? The issue with this approach is that high expected returns never come alone. They come with the risk. When people think about the investment portfolio, they tend to focus on their expected returns only. But there is a second and equally important parameter. It's investment risk. When we as individual investors manage our investments, we are not aiming to beat the market or generate the highest possible returns. We want to increase our chances of achieving our financial goals and accomplishing that with the minimum reasonable effort and risk. That's why we don't always want to aim for the highest possible return. And then, knowing the expected return, we can adjust our contributions to make sure we don't oversave or undersave for the financial goal. This chart shows the distribution of returns depending on the risk. If you take a lot of risk, let's say this is the highest one, you should be prepared that your portfolio may end up anywhere on this distribution line and be okay with that. By managing returns, risk, and contributions, we optimize our chances of achieving our financial goals and reduce the chances of oversaving and undersaving when working on our goals. Now with this theory, we are ready to go into the demo. All right, so I'm currently in a demo account and we already completed the first 4 models and built a financial projection for the family. So we know their expected cash flow and how net worth is going to change. I wanted to make sure you see these life events. It's a group of income and expenses. We just group them together and organize them because there are many of them, as you can see here. And grouping them helps us then create our financial goals in the next model. When we click on the financial goals, it asks us first to select a projection because we may create multiple projections with our clients and when we do what-if analysis. For this demo, I will be using the projection called Financial Goals Demo, so I'll select that. And when we start from the beginning, the first question that the platform will ask me is, what's my preferred planning style? As I mentioned, we at Nauma, we really believe in the idea of separating our portfolios for the financial goals, which is listed here as an advanced approach, because it allows you to do better tax planning and risk management. But we also support the basic approach when you just have one portfolio for all your financial goals, which is less accurate, but it's simpler to do. For the demo, I will go with the advanced approach, and I will show you that it's not that hard actually. So we'll select that, and when I click that, the first thing that it asks me is the name of the financial goal. So let's say the first goal that we are going to save for is going to be for retirement. Some people don't like the word retirement, so we probably will go just and use financial independence. But the idea behind this financial goal is to cover our living expenses when the family will stop working. When we create the goal, so the first question we are getting asked is what life event we would like to include into this financial goal. These are life events that we created in the previous step. And the idea on this screen is that we are trying to estimate the annual cash flow deficit, which is the difference between income and expenses in each year. Very few families actually have constant withdrawals during their retirement. Most of the time, it's variable. And here we are trying to estimate it as a difference between income and expenses. If there is a deficit, this deficit is covered from the savings. And you can see that it will change for this family over time. We also sometimes want to include multiple life events into the same goal. For instance, I don't want to have all expenses associated with my home be a separate financial goal. I'm going to include it into these life events. And the same applies for cars for the family. So I'm including them. So you see, every time when I include life event, it recalculates the cash flow deficit. So then we click continue. And now on this screen, we are now asked to set up a fund where we have contributions and withdrawals from this fund, and we have a fund balance. Because we haven't added any money into this fund, it starts at the zero and almost immediately it goes under the water because we have expenses. So now let's start adding funds into this fund. And we'll start with tax-deferred accounts because it's a retirement fund. So for this one, I'm going to use the entire 401k account for the family, and I will click apply. A few things have changed immediately. So first, the fund balance graph have changed, right? But we still run out of money, which suggests that it's not enough money to cover this deficit. And then on the left, we also noticed that there are some tax estimations that were added. So the platform is smart enough to understand that this is a tax-deferred account that we added. The family lives in California, so it pays federal and California state tax. This account withdraws are taxed at ordinary income tax level, and it estimates the taxes based on the family situation. As you can see, that's still not enough, and we are going to add money from taxable accounts. And let's put all the money that we have in a taxable account, and let's click save. So now a few things have changed actually. So the estimated tax has changed. So now it's less than it was before, because when we take money out of our accounts, we first take money from taxable accounts. And then after that we go into tax deferred, which never happens actually here because we are highly oversaving for this financial goal. Now what we're going to do is that we are going to reduce the allocation, and let's go maybe 670,000. Now we're a bit under saving, right? So our goal is to find the sweet spot. Maybe we'll do $900,000. Let's give it a try. Okay, it's pretty close. Maybe 860. Okay, so now the platform says that we have a balanced plan, and it shows that the percentiles, 30 percentile, 25 percentile for the fund is reasonable. Assuming the model portfolio is balanced portfolio, which is simply 60% stock, 35 bonds. It's not a customized portfolio, right? It's just a very simple portfolio that we have to get started. But later, if you want, you can customize that and set your own expected return and volatility, which is a measure of risk, and use that for your calculations. Now, we know that the family is going to contribute into these accounts, so they are going to contribute into their 401k. So we'll do that annually and change over time match inflation, start in 2025 and end when Steven will stop working. The second partner also works and contributes to their 401k account, Sophia. So she will do the same thing until she retires. Sophia, and then start date we'll set again January 2025, and I will say that until Sophia retirement. All right, so now given that we have these contributions, we don't need to save that much, so we can actually reduce the initial allocation because there are these contributions. So what about if we do for 60, maybe 560, click apply. Okay, pretty close. So maybe we can just reduce that, maybe a couple $20,000, maybe another $20,000. Okay, so we are pretty close, I would say. Here we go. All right, so we found our allocation and a set of initial fund allocation and contributions. in the portfolio. And then we can actually play with that and see what will happen if we adjust the risk. Let's say if we go with the conservative portfolio, right? You see that we are running out of money sooner. That's because the expected return of this portfolio is much lower. Now, if we go with aggressive portfolio, we see that we are oversaving more. So how do we make that decision? I think what's at the end of the day is important is probability of the success. So this is the result of the Monte Carlo simulation. And with aggressive portfolio, the chances is 83%. And then with the balanced portfolio, the chances are 75%, which is quite interesting, right? We're increasing the risk in the portfolio, and we are reducing the risk on the goal level, which suggests that you don't always have, by taking more risk, it doesn't mean that you are reducing the chances of your success. All right, so we're going to save, we'll go with the balanced portfolio, and we're going to save it. Now we're going to do for other goals the same way, and we'll do that for college stuff. And we already have a life event associated with that. So actually expenses here, they include not only college, but also school and other. That's what the family decided over time. So we add that, and then we have the same process here. So we know that the family has a 529 account open for both kids. So we will use one of the accounts for STEP. Click apply. We see that we are getting better, but it's not enough. So we need to add a little bit more money. How about $100,000? Click apply, and we probably need to increase that to maybe 150. A couple things have changed here. Since we started to add taxable accounts, so you see that there's also tax estimates that are added, right? Because we need to pay taxes on this. What about 170? Okay, maybe 119. Click apply. Okay, so I think we're pretty good. So there's just a small difference, and I think this is totally fine, given that this is again 25 percentile. Right now, the platform doesn't let you choose the percentiles. I think we need to extend the interface because sometimes people want to be even more conservative and change that. But if you don't like it, you can always just look at the Monte Carlo results. Given that Steph is going to college relatively soon, we're going to reduce the investment risk in the portfolio. And for that, we'll actually need to increase the contributions. Click apply. Okay, so I think we're good. So let's take a look what Monte Carlo tells us. The chances of success is 72. I'm not happy about that. Actually, I'm going to increase that. So here's what I'm going to do. I'm going to add a contribution, maybe $5,000 a year, because, and I will be contributing into taxable accounts because that's for school. Frequency annually, change over time, match inflation. It's going to be done by Steven. In calendar date from January 2025, and I will do that till Steph turns 18. Click apply. So I increased it to 85%. Okay, I actually want to push it to maybe 90%. And maybe we'll have another video to talk about how to choose the risk and portfolio success for yourself. Okay, we created the second goal, and we have $2.4 million not allocated towards any financial goal for this family. So we're going to create college Kevin because they have 2 kids. Click, select Kevin. Kevin also has some school expenses and then college expenses. Press continue. We choose again a tax-free account for Kevin. You can see already that we already used 529 account for Steph. Now it's not available anymore. We can't use that. That's the platform helps you actually avoid double using the accounts, which is very convenient. So click apply. We need to, how about we do $150,000, we allocate from that for all these things. And again, maybe let's do the same thing. We'll add $5,000 a year for the kid, and we'll be contributing into Vanguard brokerage account annually, match inflation. Owner is going to be Steven again, and start date will from this year to when, let's say, Kevin turns 18. Kevin age. So how does it help us? Now we probably need to contribute a little bit more. Okay. And how about $20,000? Okay, so we are almost there, maybe 22,000. Okay, 20, how about 25, so that to make it easier. There we go. So, okay, I think we are good, and the platform tells us that we have a balanced plan. But again, because Kevin goes to college pretty soon, we probably want to reduce the risk. Again, that's just for demo purposes, but the difference is relatively small. And again, so we got 74% chances. I think for Steph, we said that we want to be something like 90%, right? Let's be consistent and increase our contributions and push that to something like 90%, 92%. I think this is good. So we save that. And there are a few other goals that that the family has at the moment. So one more is a long-term care fund. The reason we are separating that is because we have separated HSA accounts, and I believe it's here. No, it's not here. We didn't add it in this demo account. But sometimes you want to separate HSA because these are medical expenses that family normally have at the end of their life. And it's a good idea to use tax-advantaged accounts there. So because for this demo, I haven't added a separate HSA account, I will just go and use 401k Roth. And I'll probably start with $200,000 for this one. It's okay, but it's not enough right now, so I'll do maybe 300 actually. So let's see how it goes. Click apply. No, I think we need, okay, so it says, first of all, it says that we have only $237,000 in this account, so we will need to add 250. Yeah, so some money from taxable accounts, maybe just 200. Click apply. Okay. I think we're good. And actually for this one, we can actually go with a very aggressive portfolio because we don't know, it's pretty far in the future. So the family is currently healthy, they don't see immediate needs, so they can actually take more risk and we can reduce that allocation. As an example, okay, actually, how about 100,000? Click apply. Oh, even less. How about 80? Okay, so it's very interesting. Do I really need this account then? Yes, I need, but maybe just 40,000. Okay, I think we're good. For this one, we tested in a portfolio simulation. Again, I think we can take more risk, but if you want to be more confident, you can push that based on your preferences. I'll press fine. So what else we have left here? We have parent support. So the family has elderly parents, they want to take care of them, and it's right here. Again, we have some accounts. Let's see how much we're talking about. Total is almost, okay, so we're talking about like $15,000 a year. Okay, makes sense. So we can probably go with let's go for $200,000 to get started. Yeah, I think it's pretty close. I just need to increase it to maybe $40,000 and we'll be fine. So again, you can see that because it's a taxable accounts, the platform estimated taxes for that tax provisioning. So when you withdraw money from these accounts, you also know how much you need to reserve for the taxes. All right, so we can actually go with maybe a moderately conservative portfolio because we're going to use the money pretty soon. So we need to balance that. Click continue. I'm fine. Let's say I'm fine with this risk. Click apply. So you see that we keep building this table, and not allocated funds increase, decrease, right? And we still have money left. And then maybe a couple more philanthropy. I always struggle to write that. Okay, so click OK, and we have a live event for this one. And so philanthropy is special because sometimes you want to plan it so that you can take advantage of the charitable deduction, and it's not always like that. So you may actually move some bigger portion of your money into your DAF account, and then you may want to spend it from that account over the time. So you want to be aware of like how you want to present it into your fund, whether you want to record a transaction from your brokerage account to your DAF account, or you want to record it as here as actual donation. So there are different options here. So, and we say, okay, 200, maybe 280. I'm just guessing, okay, I'm over saving a lot, and I'm going to reduce it to 200 and maybe 170. Okay, so I think I'm almost there. Click apply. Okay, we're good, and we'll click continue. Again, we just go with the balanced portfolio, but you can always customize actually and start playing with that. For instance, this is the value for the, I think for a balanced portfolio. Let's take a look. What is my portfolio? So it has explanation. So yeah, that was balanced portfolio. And we can always say that, oh, my portfolio with the same volatility, it's going to have maybe lower return. I don't know, I'm just not a good investor. What will happen? Right, click, and I need to select normal distribution. I'll talk about that later. And you see that how actually returns affect the portfolio success, right? So what if I aim for 9% return? So you see that my probability of success went up. Now, the interesting thing I wanted to show you while we're here is that if I reduce the volatility in the portfolio, my chances of success improve significantly. So volatility is one of the reasons why the portfolio success goes down. And sometimes one of the ways to increase your portfolio success is actually reducing volatility in your portfolio. Okay, so this is unrealistic, but maybe if we say, okay, 5%, okay, it's not going to end well. Maybe, okay, let's say we have a portfolio with 9% and volatility 1, which is never the case, but we'll save it. All right, I think we are done with our financial goals. Now, the family has a basic financial plan. They have a list of the financial goals. They articulate it. They know when they're going to spend money, what their total expenses are going to be, right? How much they're going to take from their accounts. What is the initial fund size for each goal, and how they're going to contribute over the period of time, and how they're going to invest this money. So this is a good guidance for them, and if they want the details, let's say for the financial independence, so they can see what are the planned contributions. So now we can actually take this information and can say, hey, Steven and Sophia, so for your 2025, you're supposed to both contribute into your 401k accounts, $23,000, then contribute to college for Steph and Kevin, and that's it. For the rest, you can do whatever you want. And another important thing is the family gets an opportunity to think about not allocated funds. Most of the families actually who work in tech, they have a risk of over-saving and finding themselves in their 80s or 90s sitting on millions of dollars and realizing that they could have had more experiences in their life. When the family does this exercise, they can actually see this number, and then they can think about what else I would like to do in my life that involves money when today, right, when I have health, I have time, I have my family around, and I want to do things. So that's a very good insight for the families. All right, I hope that this demo was useful. Please let me know if you have any questions. I'll be glad to answer them either in the comments or over the email. And give a try to Nauma, and see you in the next video.